All right, everybody should be able to see my screen here that says college savings planning. We're going to jump right in and get started. And for any friends who may have missed the beginning part, we're going to post the recording on our site, and I'll send a link out to everyone with all of that information. So, welcome to our presentation regarding college savings planning. What we'd like to do today is give you some helpful information about how to begin a college savings plan. So you'll be seeing information about current and future college costs, and we'll go into some detail about the ways in which you can save for college expenses. So you're going to learn about 529 plans, covered L accounts, and other methods of paying for college. So if you are struggling right now with planning for college costs, or if you have any questions, please feel free to add them at any time in that Q&A box. And let me know. You should be able to see it there. Let me know if you have any questions, and we'll get started. So it's pretty rare to pick up the newspaper if you get a physical one or a magazine without seeing an article about the increasing cost of going to college. When you add up tuition, room and board, books, travel, other expenses, the total cost of 1 year at a public or private college may seem just impossible. The College Board, a not-for-profit organization whose mission it is to connect students to college opportunity and success, you should definitely check it out if you haven't yet. But it's a key source for college costs, and recently reported in a report called Trends in College Pricing and Student Aid that a moderate college budget for an in-state student attending a 4-year public college in 22 and 23 averages about $27,940. So you can see in the middle of that screen there that that is the low end of what college is costing. For out-of-state students at a public college, the average budget comes to $45,240. And for students attending private colleges, the average budget is $57,570. So that's the high end of that range there on the screen that you can see. So these are some options that you have for paying for college. The most popular one, what you hear pretty often, is known as a 529 plan. There's two types, including a basic savings plan and a prepaid tuition plan. Covered L education savings accounts are another widely used method of putting aside money for college. And you may not have realized that U.S. savings bonds can also play a role in paying for higher education. And then if you haven't heard of UGMA or UTMA accounts, they're called Uniform Gift to Minors or Uniform Transfer to Minors. These are also have been used to pay for college. And then, of course, good old student loans. So we're going to go through each of these options and look at them pretty carefully. So first, I want to talk about Section 529 plans. A 529 plan is an education savings plan operated by a state, except for Wyoming, designed to help families set aside funds for future college costs. It's named after Section 529 of the Internal Revenue Code, which created these types of savings plans. Yes, not creative, but there we have it. 529 plans are established by states, as we mentioned, except for Wyoming, but Wyoming does have a partnership with Colorado, and some states have more than one savings plan, college savings plan. And anybody can establish a 529 plan account, a parent, grandparent, friend, and you can invest in a 529 account of another state. So if I live in Maryland, and I have a niece who lives in California, I can invest in a California plan for my niece and vice versa. There's many different ways to do it. A beneficiary can be anyone, including yourself. The only requirement is that the person be a U.S. citizen. And then there's two different types of 529 plans, as I mentioned. Savings plans work a lot like a 401k or an IRA, by investing your contributions in mutual funds or similar investments, and your account goes up or down in value based on performance. So prepaid plans let you prepay all or part of the cost of an in-state public college education. They may also be converted for use at private and out-of-state colleges, although this varies by state. So while 22 states once offered prepaid tuition plans, only 9 states still do it. And this is due to the rising cost of tuition, state funding shortages, and other economic issues. The 9 states who still do it are Florida, Maryland, Massachusetts, Michigan, Mississippi, Nevada, Pennsylvania, Texas, and Washington. So if you live in any of those states, you can check out the prepaid plans. So the person who opens the account, not the beneficiary, owns the account and retains control at all times. So if I open an account for my daughter, I'm the one who owns the account, not my daughter. So I would be the one who decides how to invest the money that's contributed, how withdrawals can be used, and can change the beneficiary to a different family member like my son. So I could change it from my daughter to my son and vice versa, back and forth. So, unlike Roth IRAs and Coverdell education savings accounts, 529s have no income limits, age limits, or annual contribution limits at all. Initial minimum contributions often start as low as $25, and then monthly contributions can be as low as $15 in some states. Again, you need to check out your specific state's plan and make sure that you have exactly the correct rules in front of you. Most plans allow you to, quote, set it and forget it with automatic investments that link to your bank account or payroll deduction. So you can do $100 a month and it just comes out of your bank account like clockwork every month. But there are lifetime contribution limits which vary by plan. It can range from $235,000 to $550,000. That was as of June 2023, but most people we're finding aren't plunking in $555,000 into a 529 plan. Most people are just covering kind of the basics. But again, make sure you check out your state's requirements. So for most people, like I said, estate and gift taxes aren't an issue, and contributions up to $17,000 per person in 2023 qualify for the federal annual gift tax exclusion. So even if you made contributions greater than $17,000, you would probably not have any gift tax liability because you would have to use up your federal estate tax exclusion amount, which in 2023 was $12.92 million, before you owe any taxes. And for most people, this is going to make your eyes glaze over and you're going to wonder what I'm talking about. You should have an estate plan if you don't yet. Nice plug for estate planning there. And this is where this all comes in, is how money is transferred to other people and when it becomes taxable or not taxed. So contributions to a 529 plan are made with after-tax dollars. So although the contributions are not deductible, earnings in a 529 plan grow federal tax-free and will not be taxed when the money is taken out to pay for college. So you put it in and you pull it out and you don't pay any taxes on it in between. So in addition to the 529 federal tax benefits, over 30 states and the District of Columbia currently offer a full or partial tax deduction or tax credit for 529 plan contributions. So they want you to contribute to 529s. In some cases, then 529 contributions reduce taxable income as far as state taxes are concerned. So of course, this is dependent and varies from state to state. So you need to check with your state to see if your contributions qualify. So withdrawals have two parts, contributions and earnings. If a withdrawal is taken for a non-qualified expense, meaning not for education, so let's say you take it out to buy a new car, the earnings portion is subject to federal and possibly state income tax. Although the earnings portion of the withdrawal taken for non-qualified expenses may also be subject to a federal penalty tax of 10% and state income tax penalties. So you really don't want to use this for anything other than qualified education expenses. And those include tuition, fees, books, supplies and equipment, room and board at any of those eligible higher education institutions. And even though many parents plan to use 529 funds for college, They can help pay for other educational expenses too. You may have heard that there are tax-free withdrawals available up to $10,000 in tuition expenses for private, public, or religious elementary and secondary schools per year per beneficiary. So if I have 4 children in private schools, I can take $10,000 for each of their private tuitions. And you can also withdraw up to $10,000 for student loan payments per beneficiary and per sibling and step sibling of the beneficiary. So if you went to school and got loans for them, and at the time you didn't have a 529 account, but now you do, you can take out $10,000 to cover those loans. Eligible institutions include virtually all accredited 2- and 4-year public and private colleges and universities in the United States, and also some vocational schools as well. They also include a number of colleges and universities outside the United States. All right, this is a really new feature, relatively new benefit of the 529 plan, effective January 1st of 2024. The Secure Act 2.0 of 2022 made it possible to roll over 529 plans to a Roth IRA without incurring penalties or taxes. That's a pretty big deal. The lifetime rollover limit is $35,000, but the contributions for 2023 are subject to annual IRA limits. So you can't put more in than you would normally to an IRA. So $6,500 for most people and $7,500 for those over age 50 for 2023. 529s must also have been open for more than 15 years. So a lot of rules here and boxes that you need to make sure are being checked, but a really great new feature. All right, there may be some tax advantages to using your state's specific plan as opposed to another state's plan, such as tax deductibility of contributions and/or tax breaks for qualified withdrawals. The tax feature alone might make your state's plan appealing, but you should definitely check out other states' plans too. And there are some important factors to consider as you're doing your research. So a couple of questions. Are there state tax benefits for residents or negative tax consequences for non-residents? First thing to look at. What investment options are available and how much investment flexibility is available? What are the fees? What are the minimum and maximum allowable contribution amounts? Are there restrictions on who can be a beneficiary, and can a beneficiary change be made? What are the options for account access, customer service representatives available by phone, online enrollment? The last thing you want is trouble accessing your account. What is the process for making withdrawals? Is paper documentation required? Can payments be sent directly from the plan? Anyway, these are all questions, and we're going to, again, send this all out to everyone. These are questions as you review 529 plans that you're going to want to consider as you do your research. Next, we're going to talk Coverdell Education Savings Accounts. Not often as commonly known anymore after the benefits of 529s, but these are tax-preferred savings and investment accounts that were authorized by the IRS code to encourage people to save for future education costs. They used to be called education IRAs. The Coverdell Education Savings Account became very attractive college savings vehicle for many people, including families who wish to save for elementary and secondary school expenses, as certain K through 12 expenses were added to the list many years ago of qualified expenses. So before the 529 plan allowed you to take that $10,000 a year out, Coverdell accounts were the only way to pay for K through 12 expenses. So even if you like the 529 plan, you may still decide to contribute to an Coverdell Education Savings Account for that benefit alone. You can contribute $2,000 of savings for each child into a Coverdell account, but there are some items to be aware of, such as the beneficiary has to be under age 18 at the time that the account is established. And the contribution limit is $2,000, which is pretty low considering that a private K through 8 school in our area can cost up to $12,000 a year, and some of them even more. So you need to be careful when accounts are established by different family members for the same child. If total contributions exceed $2,000 in a year, you can owe penalties. So if I have a Coverdell savings account and my sister has a Coverdell savings account and we're both contributing for my daughter, and we can both contribute over $2,000, there's penalties. So you have to be really careful about coordinating how much you put into these accounts. The relatively low contribution limit means that even a small annual maintenance fee charged by the financial institution could significantly affect your overall investment return. So your contribution goes into an account that'll eventually be distributed for your child, if not used for college. You can't simply refund the account back to yourself like you can with most 529 plans. So this means you do lose some degree of control with these types of plans. The education savings account is on equal footing with the 529 when applying for financial aid, federal financial aid. So the account is considered an asset of the account's custodian, which is typically the parent. Withdrawals are not reported as student or parent income as long as it's tax-free for federal income taxes. So no real advantage to either one for the federal financial aid. Coordinating withdrawals with other tax benefits, especially the HOPE or lifetime learning credits, can be really tricky. The account must be fully withdrawn by the time the beneficiary reaches age 30, or else it's subject to tax and penalties. So a lot of things to consider with the Coverdell accounts. Earnings in the Coverdell accounts are tax deferred, just like 529 accounts. Similarly, if withdrawals are used for qualified education expenses as defined by the IRS, they are exempt from federal income taxes. And then again, if a withdrawal is used for non-qualified expenses, then it's subject to federal, perhaps state income tax. And then in addition to a federal penalty of 10%, you're getting a theme here. There's a penalty for using these funds for things that are not qualified education expenses. So make sure you read the fine print very carefully. Contributions to Coverdells are made with after-tax dollars. These contributions are not tax deductible. So annual contributions to any Coverdell account are limited to $2,000. And that limit is $2,000 per beneficiary, not per contributor. So if I have 4 children, I can give $2,000 to each child. So if the same beneficiary is named on 2 accounts, the total contributions for the 2 accounts cannot exceed $2,000. So it's $2,000 per child, no matter how many accounts you have. Contributions can be made until the beneficiary reaches age 18, but there are higher age limits for special needs persons, and there's a lot of rules on that. So please check the fine print on that before you enroll. There are some income restrictions on those who can contribute to an education savings account. So again, please check those. The filing as a single taxpayer can make a full $2,000 contribution if their modified adjusted gross income is $95,000 or less. So that's if you're single. Partial contributions for those up to $110,000, again single, and then but more than $110,000 you can't make a contribution. For married filing jointly, it's a modified adjusted gross income of $190,000 or less. Anybody between 190.01 to 220 can make a partial contribution, and then no contributions can be made if the adjusted gross income is greater than $220,000. So again, a lot of different rules here. Please check and make sure that you fall into any of these categories before contributing. All right. Beneficiary of the Coverdell or his or her guardian, if the beneficiary is a minor, controls the account and can make withdrawals at any time. With the exception of a special needs beneficiary, any balance remaining in the account when the beneficiary reaches age 30 must be withdrawn. Balances can be transferred without tax penalties to another member of the beneficiary's family, who could be spouse, child, grandchild, brother, sister, father, mother, etc. So if my oldest child doesn't use everything in their Coverdell account, it can be transferred to my youngest child, as an example. Okay, U.S. savings bonds, UGMAs, and UTMAs. You can also consider these different types of accounts. Some or all of the interest earned on U.S. savings bonds may be excluded from income. Again, the rules are really, really complicated here, but they must be qualified, which means that they must be Series EE bonds issued after 1989 or Series I bonds. Bonds must be issued in the name of the taxpayer, not the name of the person whom the education expenses have been paid. So for that example, it would be my bond that I am paying for my child. Qualified expenses include tuition and fees, but don't include room and board. These expenses can be paid for the taxpayer, his or her spouse, or dependent for whom they can claim an exemption. So me, my husband, or my children who are on my living under my roof, essentially. Credit for using savings bond interest for education expenses is taken when you complete your federal income tax return. Accounts set under the UGMA or UTMA Acts, Uniform Gifts to Minors and Uniform Transfer to Minors Act, have been used for many years to pay for college educations. And one of the advantages they offer is that a portion of the earnings in these accounts may be either tax-free or taxed at the child's tax rate. Taxation at the parent's tax rate is until the child reaches 18. So one disadvantage is that once the child is no longer a minor, he or she controls the account and how the money is spent. Depending on the act and the state, one is no longer a minor between the ages of 18 and 25. So one of the states that we have a lot of dealings in, the age is 21. So at 21, it gets transferred to the child. These accounts can be rolled over into Section 529 plans, but account control remains with the beneficiary once he or she is no longer a minor. Some financial planners suggest keeping an UGMA or UTMA if you already have one, spending down the account for the benefit of the minor, and opening a 529 plan for all contributions. These savings vehicles can get really complicated from both an estate planning and education funding standpoint. But to consult a financial or tax advisor for more information about how they affect your specific situation and how they coordinate with 529 plans is really, really crucial, especially considering that these rules and laws are changing every year. I've been in the industry about 9 years now, and when I started, things were much different than they look now, and it's really important to keep on top of all of these little details and make sure that you're sticking with every single rule and law that's coming out every year so that you're not at a disadvantage. So now we're going to talk about student aid and loans. This tends to be everybody's favorite section. Once you're accepted to a college, or your child is, you'll receive a financial aid offer letter that may include assistance from a variety of different programs. So federal financial aid is available in the form of grants, work-study programs, and loans. Some of the loans do not have to be paid back if certain conditions are met. And to apply for these programs, you have to submit what's called a FAFSA, a free application for federal student aid. And the Department of Education offers the following loan programs. Again, I'm going to send this all to you. But just so you're aware of what they are: direct subsidized loans, which are loans made to eligible undergraduate students who demonstrate financial need to help cover the cost of higher education at a college or career school. Repayment for these typically starts within 6 months after graduation, leaving school, or going below half-time attendance. And the current interest rate for loans varies depending on the year, but anybody whose loans were distributed on or after July 1st, 2023 and before yesterday, July 1st, 2024, is 5.5% for undergraduate students. Direct unsubsidized loans are loans made to eligible undergraduate, graduate, and professional students, but in this case, the student does not have to demonstrate financial need to be eligible for the loan. So you'll pay the interest on the loan, and it begins accruing immediately. So the same repayment rules as subsidized loans apply, and the current interest rate is 5.5% for undergraduate students, and 7.05% for graduate or professional students. So you can see there's a huge difference there between subsidized and unsubsidized loans, and it's really important that you read the fine print and look at the difference at what you've been offered. You may have heard of PLUS loans, PLUS, made to graduate or professional students and parents of dependent undergraduate students to help pay for education expenses not covered by other financial aid. Again, the same repayment rules as subsidized loans apply, and the current interest rate is 8.05% for parents. You may have also heard of Pell Grants. Other types of federal student aid grants are available as direct aid, which means that they don't have to be repaid. This is based on exceptional financial need and the cost of attending college. And what we get a lot from people is that thinking that they apply for these Pell Grants and that everybody gets them and you're not going to actually have to repay these loans, any of these loans that you get. But actually so few people really qualify for these Pell Grants. You really have to understand that federal student aid just means they're going to help you with your student loans, not that they're giving you money that doesn't have to be prepaid. Or like I say, it's not free money. They're giving you options for paying loans, not free money. Some students can also benefit from state financial aid programs. General information about these programs that you can find at, there's a website, National Association of State Student Grant and Aid Programs. There's a lot of money on the table out there. Sometimes you just have to find it. And then there's also private assistance programs, corporations, foundations. Sometimes the companies that you work for may offer a small scholarship for, if you write an essay, you apply, etc. Some colleges also offer additional financial aid based on merit or need. If you have, academic scholarships or sports scholarships, things like that, you want to make sure that you keep in contact with the school's financial aid office to see what other forms of aid are available. Then there's also 2 federal tax credits available to help with paying for college expenses, and we're going to look at those really quick. The first is the American Opportunity Credit, which provides a tax credit of up to $2,500 per year per student, which can be claimed for a qualified higher education expense for students in their first 4 years of post-secondary schooling. There's income limits to this to be able to take advantage of this credit. As of July of 23, if the taxpayer files as a single, then you have to have a modified adjusted gross income of no more than $90,000. If married filing jointly, it's $180,000. The Lifetime Learning Credit allows for a tax credit of up to $2,000 per year per tax return. So credit can be claimed for qualified higher education expenses as well for students at any stage of their post-secondary education. You don't want to mix up these two. I had a friend had this happen to her when we were both serving in the military, and it chased her around for a long time trying to pay back what she owed the IRS. Like the American Opportunity Credit, there are income limits in order to use the credit, and as of 2023, taxpayer files as single, then your modified adjusted gross income must be less than 90 for a partial credit, and married filing jointly is 180. So you definitely want to make sure that you check the IRS's publication, called 970 Tax Benefits for Education, or discuss with your tax professional. So now we're going to go look at a little bit of student loans, which everybody has been hearing about lately because of the news. And we hear and see reports and articles about the debt all the time that many students are accumulating. But what's actually happening and what are the facts? So there's about 43.5 million student loan borrowers with outstanding student loans. And total student loan debt is estimated to be 1.7 trillion in the United States. Student loans have a delinquency rate of 11%, and most of those are default within the first year of repayment. And then each borrower has an average of $37,787 in student loan debt. And obviously these figures are a cause for concern. And this debt doesn't just affect recent graduates, it even impacts people into their older years. So you can see that even people 62 and older still have some student loan debt. So it's not just young people. So what are the options if someone is struggling to make student loan payments? Temporary solutions include asking the lender for a suspension of payments for a specific period, or a reduction in the amount of the payment for a time, or extension in the time period to repay. The critical thing here to understand is that if you are having any issues making student loan payments, call them. Call the lender, talk to them. If there are multiple loans, another option is you can refinance or consolidate, although the terms are often used interchangeably. They're kind of two different things. To pay for college, you may have used a mix of loans from private lenders and loans from federal government, and the interest rates, balances, and terms for each of these loans vary wildly. And some of your loans may have variable rates while others have fixed rates. So refinancing can only be done with a private lender, including banks and credit unions, is designed to help you combine all of your student loans, federal and private, into a single, more affordable loan. The new refinance loan will have a brand new interest rate, which, if your credit score is in good shape, could be lower. If you have federal loans and want to maintain the protection and other benefits that come with them, you have another option, which is called consolidation. That's why the two terms are different. Federal loan consolidation involves combining all your existing federal student loans into one single loan with the federal government. Unlike refinancing into a private loan, which allows you to refinance both federal and private loans, the federal government does not allow you to consolidate private loans. So another key difference here. The interest rate is a fixed rate. It's not necessarily lower. As a matter of fact, it's usually not lower. Rather, it's a weighted average of all the interest rates on your current federal loans, rounded up to the nearest 1/8%. So the U.S. Department of Education does offer direct consolidation loans with no application fee, but it's important to understand that refinancing and consolidation are not the same thing. Refinancing is usually your best option to save money, while consolidation is your best option for maintaining federal loan benefits. So the option that's right for you really depends on many different factors, and you're going to want to make sure that you check every single one of those things: interest rates, federal benefits, creditworthiness, income, before you make a decision on what you're going to do. All right. Nearing the end here. I've seen some questions roll in. If you have any more, go ahead and drop them in there. For many individuals, doing a cost-benefit analysis is really helpful. Borrowing for college is usually the truest path to earning a degree if your parents couldn't help save up. So, however, with all the talk of the student loan crisis, six-figure student loan debt, unsustainable student borrowing, it's easy to wonder if borrowing for college is a good idea. Many colleges and universities provide opportunities to earn a bachelor's degree in everything from computer science and biochemistry to painting and psychology. And some majors provide a clear and direct path to high-paying and widely available jobs, and others not so much. Students can do the research themselves to see which careers are most in demand and offer the best pay, and then decide if taking on the amount of student debt they're considering is worth it. They can determine which degrees and which schools offer the best return on investment. The federal government's Bureau of Labor Statistics publishes an annual occupational outlook handbook online, and anyone can consult this handbook to find the median pay and projected demand for workers in almost any occupation over the next 10 years at various levels of education. And probably my favorite example of this is a friend who wanted to study drama at a very expensive school, private school in California. And the parents sat my friend down, and I was in high school at the time too, sat my friend down and said, hey, here's what it's going to cost for you to go to this school, and here's how much you're going to make afterwards. And they were very blunt with my friend, including like, hey, if you're waiting tables because you can't get a job, you're not going to be able to pay off these student loans. So it's really important to have these conversations with your children. So we've looked at a number of different ways to save for college education expenses and through income tax credits, lessen the burden of rising college costs. Saving plans like 529 and Coverdell education savings accounts are very popular ways of saving for future college expenses. They're widely available and geared specifically to those planning ahead for higher education. U.S. savings bonds interest can be a way of paying for some college costs and getting an income tax break at the same time. The UGMAs and UPMAs, also long-standing legal arrangements that can be used to put aside money for a minor's college education. And then there's quite a few options related to federal and state student grants and subsidies. We've also looked at 2 federal credits that can help with higher education expenses. And lastly, we've looked at student loans, which are a financial resource used by many. So we will make sure to send out all of this information to everyone after the fact and have this recording available. I'm going to answer some questions that we just got in. And if you have any questions while I'm speaking, please just go ahead and drop them in. The first one is, what about grandparents' 529s? That's a great question. I'm going to stop sharing my screen here. How do I get out of here? Grandparent 529s are a great way if you're lucky enough to have a grandparent that really wants to help out with planning for college and saving for education. Grandparents can contribute to a 529. So unlike the Coverdell account where it's a $2,000 max across all the people who are contributing, if I wanted to contribute $100,000 to my daughter's 529 and my mother wanted to contribute $100,000 to my child's 529, that's perfectly acceptable. The difference between grandparent and parent 529s, actually, most of it disappeared recently as of 2024 with the new provisions on the FAFSA. So it no longer requires students to report cash support, which is what it's called. So it doesn't have any impact anymore on need-based financial aid eligibility. So it used to be that if you took money out of a 529, grandparents' 529 account, that was 50% of that was reported as untaxed student income. So it's not that way anymore. That's a new FAFSA rule. But in some private schools, they don't use the FAFSA. They use what's called a CSS profile. And that is still used. So it's very important to make sure if you're filing a FAFSA or a CSS to know which one to use and which strategy to use, because that's a big difference. Other questions? My family and I would like to save for our child's education, but are unsure how much we're going to be able to afford. Okay. So one of the things that we all know about investing is that the most important thing you can do is early and often. There's charts all across the internet about, Sally invests $100 a year starting at age 25, and Sarah invests $100 a year at age 35, and the chart looks much different. So it's early and often. Even if you can only do $25 a month, in part of that presentation we showed you, it talked about how minimum initial contributions can be as low as $25. And then you can contribute monthly as low as $15 in some states. And so over the course of 18 years, that could end up being a huge help to your children. If you're not able to help them pay, my parents said to us, we're going to invest in 0 to 18 and you're on your own after that. And if that's what you're going to do and where your value lies and you really want to help your kids with college education, but you're just not sure you're going to be able to afford enough to make it worthwhile, start with the absolute minimum and go from there. Because by the time that kid hits 18 and you're looking at 4 years of college, maybe, sometimes two, every little bit is going to help. Even if it just pays for a portion of those costs, every little bit helps. Okay, let me see what other questions we have here. How about K through 12 education? Okay, yes, we did briefly discuss K through 12. You can use a 529 for $10,000 a year for K through 12 expenses. We are pretty much finding, though, that nobody is overfunding their 529 account enough to be able to take $10,000 a year out and still cover hundreds of thousands of dollars of college, over a 4-year period. But sometimes it's necessary, and sometimes that's where people's value lies. And if that's what you're looking to do, it is now allowed that you can take $10,000 a year out for private education. Other questions? That is all of them. Alrighty. Thank you very much, everybody. We will send out this information later and have this available to you so you can look through it. As always, you can email me or give me a call. I'm pretty sure you all have my information if you signed up for this webinar. So let me know if you have any questions. I'm happy to help at any time. Have a great day, guys.